Welcome to All Things Financial with Jack Driscoll. Each week, Jack takes on all things you thought were hard to understand about your finances and makes it fun, easy, but most of all interesting. From insurance to the best way to save your money and squeeze the most out of the dollars you put aside for your rainy day. And now, you have a friend in the money business. Here's your host, Jack Driscoll.
Okay.
All right, here we go. Welcome back, everyone, to another edition of All Things Financial. You know, one of the areas in financial planning, you could tell I'm losing my voice. Actually, it's coming back. It was worse yesterday. And I've told people in financial planning, when we talk about consequences of why you need to do a will, why you need to buy life insurance, why you need to do disability insurance, why you need long-term care, and people say, that'll never happen to me. And I use the example all the time of, okay, if you think you can control things, we have no control over what will happen to us. Try to prevent yourself from catching your next cold. And look at what just happened. I'm proof in the pudding. So what I wanted to do over the next couple weeks is a series on kind of preventative measures and protection of financial matters. And I brought on the show with me today a guest over the next couple weeks, Ian George, who's a specialist in insurance. And I wanted to bring him on. What an appropriate time, with me losing my voice being a case study, a classic case study, in that we have no control over what's going to happen to us, but we can control the consequences we allow those circumstances to have. So Ian, I want to turn it over to you. I wanted to ask you a couple questions. If you could share with all of the viewers and listeners on the radio some concepts about how to protect wealth and protect ourselves in the future should unforeseen circumstances happen to us prematurely.
Well, Jack, thanks for having me, and I'd be happy to. So, yes, within the planning process, I do a lot of work with individuals and advisors in helping to figure out appropriate strategies with life insurance. What we found out is that the easiest way to start this conversation generally is how much. It's always a big question. A lot of people pick random numbers out of the air and will choose that this is the amount of life insurance they feel that they should have. I hear $1 million being thrown around a lot. If I can get $1 million of life insurance, that would be great. The interesting thing we find is that, unfortunately, $1 million is not what it used to be.
Right.
So people can often find out that, $1 million of life insurance just isn't going to get me as far as I want it to go. So the idea is, what's a good method, or what's a good way to figure this out? For a long time, financial planners, insurance agents have had nifty software that'll go through and show clients, here's what you need. And what we find actually is that there's too much mystery involved in that. Somebody's punching in a lot of numbers into a computer. Next thing you know, it spits out this death benefit, and this is what you should have. Most people would like to know where that came from. How does that work? What's going on, and what's the best way for them personally to calculate the number that makes them comfortable. Excuse me. As you know, there is no requirement for life insurance. Unlike health insurance nowadays, or auto insurance and things like that, where you have a government body who's going to tell you this is what you need to own, and this is how it works, and this is why you will own it. And if you don't own it, then you can't drive a car. If you don't own your homeowners, you can't own your house unless you don't have a mortgage, and that doesn't happen very often. So one of the things that we do is it backs up into what people are usually talking about with somebody like yourself, which is their retirement planning. Mm-hmm. And the way I look at this is essentially what we're looking to do is to say, if something happened to an individual, the idea is that obviously that person is gone, but so is their income. They can't earn any more money once they pass. So the calculation comes down to, what do we have in place? And the way I normally do it is I tell somebody, draw yourself a bucket. Make yourself a list of the assets that you have. and you want to total that, give you that number at the bottom. Now, you work with clients and talk to clients on a regular basis about here's where you are with the assets you have as we're trying to get to retirement. Retirement or distribution planning and things like that is another calculation for when you won't be earning any more income. That's when you hear a lot of folks say, I'm on a fixed income now. Well, you're on a fixed income now because you're not generating new income with work. You're now enjoying your wealth. So while, obviously premature death isn't exactly like that, there are a lot of similarities in terms of the fact is that the end of new generated income coming in has ceased. So what people will do is, in a lot of conversations, start with, how much money do I want coming into my household? Or how much is coming in now? What do we need to have that be?
On an income continuation strategy?
Exactly.
Okay.
So how am I going to continue? If I'm gone, how does my family continue to have income coming in?
Okay.
Well, the first thing you would do is you would go and take a look at all the assets that are in there that could be invested and set aside, and using various strategies there to generate income for the family. And a lot of times what it comes down to, and I'm going to oversimplify it so people can start to get comfortable with it, but a lot of times what you'll do is you'll take that number, and it'll be the number that is consisting of your 401k assets, investments you have in a side account, money you might have in your savings account, any other asset that you have that can be put in there and turned into an investable liquid asset, right? So from that number, you're going to take a drawdown rate. The most common drawdown rate that's used these days, and correct me if I'm wrong, is 4%.
And what do you mean by drawdown rate?
So basically what it means is if I have, and I'm going to start using really simple numbers. If I had $1 million of assets going into retirement, the drawdown rate that a lot of people use at 4% would yield $40,000 a year.
So you mean the rate of withdrawal from the assets, hoping they're earning somewhat along those lines in interest?
Correct.
Or that you're depleting assets over a period of time, even if the interest isn't adequate?
Right. So the general idea is that over time, that the drawdown rate of 4% will allow that money to continue to earn enough interest over time that it'll offset that 4%. It doesn't have to be trued up every year, but over time that you'll be able to beat 4% over time in terms of what's going on so that you won't run out of money. And that's the goal in retirement planning.
Okay.
I'm retired now, I want to have my income coming in, and I'd prefer not to run out of money.
So you refer to that as the drawdown rate, the rate of withdrawal.
Correct.
Annual withdrawal.
Exactly.
Okay.
So that kind of comes back into play with what we're talking about. So what we have is I'm thinking about how much life insurance would I possibly need to make me feel comfortable. And again, this is what we're talking about. We're talking about the amount of life insurance that makes somebody feel comfortable. The way I often describe it is, look, when I think about my assets and something's going to happen, the amount of life insurance I had should allow me to have some calm about the fact that I'm still building my wealth, but if something were to happen to me prematurely, my family, the people I love, will be taken care of the way I would like them to be taken care of.
Okay.
So, and the goal there comes back to this bucket of money that we have. Now, very often you will see people take a look at that number and say, you're a young couple starting out, and in that bucket of money that they have to draw down from might be $50,000. They're just getting started. Mm-hmm. They have their home. They're paying their mortgage. Well, that's why young couples often buy large amounts of life insurance, primarily because that's what they're using to take care of each other. Okay. And nowadays, when the majority of households have two working parents, this applies to both. Mm-hmm. If something were to happen to me, I would want my wife to be taken care of. If something were to happen to my wife, she would want me and my children to be taken care of as well, to make sure that we could continue the promises that we want to keep to our spouses and to our children.
And since your household budget's based on both incomes, loss of one income can affect the total budget restraint on the other one not having enough income to meet that budget. Even though there's only one survivor, the budget typically doesn't really change that much, does it?
No, it doesn't. And that's correct. So, and let me give you a quick side note too. The other thing too that we want to make sure we don't put into that calculation is the home or equity in the home. The reason for that is that if something were to happen to you, you don't want to have your wife have to sell the house to make everything work.
Yeah.
Because now they're left without a place to live, and that doesn't work out very well. So, with that being said, so I'm going to stick around and use a really simple number. So you have let's say you have an individual, they're earning $80,000 a year, and they do their calculation, and what they see is if I want to have $80,000 a year generated using the 4% number, I'm going to need $2 million.
I see.
So what's already in that bucket, or what's already on that list that's going to get me to $2 million? And the way that we get there, again, I'm going to just go over the list again. It's going to be what's in the 401k. What do you have in group term life insurance? That counts. What's already on there? Is there a policy that your parents bought for you that's sitting on there too? Get that all in there. What's in the savings account? What is, if something were to happen to you, what tools would the surviving spouse have to take and put into this investment to get to $2 million?
Okay.
And then very simply, whatever that total is, you subtract that from $2 million, and that'll give you the amount of life insurance to get you to $2 million.
So it's what do they already have, either now or at death, if they have group life somewhere or whatever, and then whatever they need to make up the difference. And then it's what they might need to fund and buy and purchase in some form of life insurance.
Correct.
That's a basic evaluation.
It's the easiest. I find that to be a really easy place to start, because the calculations that people will often try to get into a lot of depth is, what do I owe on my mortgage? Mm-hmm. So I want to make sure my mortgage is taken care of. What do I owe here? What do I owe there? What's everything going on? That can tend to be very complicated. Now, your advisor can help work with you in terms of really drilling down. So, for example, if I use an example where you have an individual who says, well, on that list already, I have $500,000 and I need to get to $2 million, so $1.5 million is where I want to be.
Right.
Now you've walked in with a concept about what you're trying to accomplish, because at least now you know what you'd like it to look like.
So the first evaluation you would look at is income replacement, mm-hmm. and design the amount of life insurance or lump sum assets required to generate that rate of withdrawal for income replacement or income continuation if a person's income stops. And dependents are still dependent on that income coming in, right?
Correct.
And then you led to, secondly, there may be some lump sum payoffs you want to make. You might want to pay off, you might need some lump sum one-time resources to just pay off bills. Is that right?
Correct. Well, and the other thing too is you can account for that too. Now, we all know, and you know this especially, that there can be reasons why you don't want to pay off a mortgage. Mortgages, can be rather significant tools with low interest rates and tax deductibility, low cost of money.
That's an excellent point.
So,
and builds credit for the surviving spouse if they were not working, especially if they continue repaying a mortgage versus have everything paid off, building credit. So interesting you bring that up.
So what's nice about it though is if you have, if the surviving spouse has the war chest, they can now work with the advisor to make smart decisions and timely decisions. So for example, the life insurance that I own now is based on a number. And it's based on a view of what I think the world looks like now. 10 years from now, that world could look very different. The one thing that I know won't change is that the surviving spouse, my wife, having that extra cash show up right when she needs it at the time of, I'm hoping the worst thing that's ever happened to her, shows up, mm-hmm. is a good thing. That she has the wherewithal to do with it what she needs to do to make the arrangements and what goes on. And that's where it comes in. The more finite you get down to it, the more you can start to be more and more comfortable of what makes sense for you. I will tell you a couple of things to keep your eye out for. So,
okay.
one of the things that we see is, well, why do I need to have the whole household income, my whole income being replaced when we don't spend all of my income?
Okay.
And you have the reason that I tell people don't discount to that too quickly, because while you won't be alive to be spending more of the income, your kids will be around. And you have things that you probably you would have wanted to take care of, such as college costs. There could be weddings in the future.
I see.
The list goes on and on and on about different things. So in a retirement plan, we talk about keeping the principal of that, of when you have that withdrawal rate of the 4%,
right.
we're doing that to preserve principal. In the event of a death benefit in that bucket, principal will not be preserved necessarily.
Okay.
Because you're going to have some unforeseen and maybe even foreseen. College is, we have an idea that that's coming down the road. Other opportunities for your kids that come down the road, that need to be accounted for in terms of what goes on as well.
Okay.
And that's one of the bigger aspects of it too, is don't discount it. So as you're taking a look at what goes on, the amount of life insurance, getting that done. Now the other thing too is, I will tell you, there are different calculations. Some I see very often and some I don't. So that calculation is pretty straightforward. The husband and the wife are both taking a look at what happens to do an income replacement.
Okay.
Be careful how you're spreading those assets in terms of whose or what's. Don't have don't throw your wife's bucket into yours. Don't throw your bucket into your wife's bucket. The reason for that is, God forbid, that you would have both the husband and wife perish at the same time. If you've had those assets cross over, the amount that you have set up for what you would want your kids to have won't be taken care of.
Can you explain that a little more?
So yes, absolutely. So if I say that we have a household income that's running on a number of different features, that would be my wife's income and my income as an example. And let's say that we have we both have 401k programs or IRAs or whatever else. If I take account of hers, so if something happens to me, well, that money goes over here, and that'll get to the total of $2 million for her to live on.
Okay.
Well, now her 401k is obviously gone for that calculation, so if something were to happen to her. So you're bringing down the number by using it for both, because in a two-income household for children, depending upon what you want to have happen, now you're replacing both incomes simultaneously.
So are you saying sometimes if one spouse dies, they might deplete some of the assets of the other spouses, and then both can't be available for the second generation or whatever?
Correct.
Is that what you mean?
Exactly.
I see.
So that's one of the things that I encourage people to take a look at. Now, there are more aggressive calculations, which I don't see very often. However, it's becoming more and more popular. So depending upon what people feel and believe, is basically you have a two-income household. Some people will say, look, I want to make sure that my wife is left with enough money so she does not have to work.
Okay.
So this comes up much more often, when you have young children. Young children are basically saying, look, if something were to happen to me, my wife would be very uncomfortable if she would have to leave the young children at daycare or not be around as much because she has to work to make up the other income.
Right.
I want to make it such that she wouldn't have to work any longer.
I see.
This is not a very common strategy, but one that can make a lot of sense. So, and it can actually go the reverse. So there are couples that have looked and said, we don't want either one of us to have to work. And a lot of times what you'll hear them say is, if they've lost one parent, we don't want them to have to lose the other one to a career.
I see.
We want the other one to be around more than ever, so to speak.
For quality of life, they'd normally prefer if they had enough money even right now.
Correct.
Yeah.
Right. Yes. A lot of us always talk about, we have two-income households. Some two-income households absolutely exist because you have two career-minded individuals who are living together.
Yeah.
Most two-income households are by necessity.
Right. So what we're striving for is quality of life. If we had enough money, this second spouse might not work anyway by choice, but by necessity they have to. So we might want to create the circumstance where it's a big strain with a single parent, let alone having to go out and work to supplement that income. I get that. That's a good option. Would to summarize then, on a very basic level, calculating how much insurance. Number one, calculating if a family needs insurance. Secondly, how much insurance would be, what income do we need? Reverse calculate that to how much assets would be necessary to generate the income we generate at work. If the assets now had to generate that income because we're no longer here at a safe rate of return of maybe 3 or 4%, then that means, like your calculations, that's how you simplicity come up with a lump sum as a first alternative.
Correct.
Okay. Well, is there anything else you wanted to wrap up with, a simplistic scenario of what else people need to think about in the amount of insurance and if they need insurance?
Yes, and what I would say, the simplest way to take a look at it is, they've done a number of studies to find out how many families have, very little life insurance, if any at all. And what I would say is, it's an uncomfortable thought, but it's also a thought that actually comes from a place of love, which is wanting to take care of the people that, are in your family, taking care of your wife and taking care of your children, is to think, if something were to happen, what would they have to use as tools to survive? And that beginning thought is what will help people start to, again, make that list and see where it ends up.
Yeah, okay. Well, appreciate your coming on. Folks, we're going to have Ian back for a couple shows here and do a series to try to help guide you through many of the decisions you have to make to protect your families. If you're not here, you could protect them in advance if something, I'd say premature, happens to interrupt your ability to earn income and to provide for your family. So Ian, thanks again for coming today. Folks, we'll be back again next week with another edition of All Things Financial. Thanks for tuning in.
Securities and investment advisory services offered through SagePoint Financial Inc., member FINRA SIPC, and registered investment advisor. Insurance services offered through Driscoll Insurance and Financial Services Inc., which is not affiliated with SagePoint Financial Inc.